Good evening. Thank you for your time. I would like to teach you this evening about complex systems, including interest and stock rates, and how to make them simple. So, one of the things that I'd like to share with you today is some statistics that were published by CNBC. And 52% of Americans are not involved in the stock market in any way. And that's really not surprising because, as CNBC noted, 1 in 5 of us, actually more than 1 in 5 of us, 21% of us, don't trust the professionals who are responsible for advising us on how to invest our money. So, what we're going to do is we're going to discuss some of the difficult terminology. We're going to make the vocabulary simple. We're going to talk about the system and how it works, and then we're going to talk about how to make the system work for us. Okay, so the first topic is going to be interest. Interest is the premium or the amount of money that someone gets paid for lending their money. Okay, so how does this apply to stocks? This applies to stocks in as much as the Fed sets a daily rate on the money that they loan to banks. But what is the Fed, you say? The Fed is actually the Federal Reserve. And the Federal Reserve is responsible for making sure that monetary policy is managed in our country, so that we don't have all of these crazy collapses like they used to have. The Federal Reserve was actually established in 1913 by the Federal Reserve Act, and they have 3 jobs. The first job is monetary policy. The second is to regulate the banking industry. And the third is to provide financial services. The Fed, in their monetary policy, is expected to manage inflation. But what is inflation? Inflation is when the cost of goods outpace the value of your money. So you're buying less with more money when inflation is going up. Now, the funny thing about inflation is that the Fed actually expects there to be about a 2% rise of inflation. That's good in their opinion. Maybe not to us, because we always want our money to be worth more than less. So stocks are the next vocabulary that we're going to talk about, because we've already talked about interest rates and we've talked about inflation. So what are stocks? Stocks are little pieces of ownership in companies. And those stocks are valued essentially based upon the value of the company. But it gets a little bit trickier than that, because when you think about your house and you know how much it's worth, or at least you know what you owe for it, and your neighbor sells their house down the street and their house sells for more, that actually makes the value of your house go up. So somebody else's valuation of a product impacts the value of your own. Now, if everybody on your street sold their house at the same time, well, of course, the prices would go down. And that's kind of what happens with the stock market, too. So if everybody is trying to sell at the same time, the value goes down. But what's happening is the Fed is actually trying to manage the economy using interest to control inflation and to increase jobs. So when the economy is slow, they lower the interest rate to help grow the economy by making it easier for people to borrow money. But when the economy is booming, what happens is the inflation starts to grow too fast. So they raise the interest rate to try to keep inflation down. But then there's less money for people to be able to buy things, and the economy slows down. But how does this help us in making money off of our investments in stocks? If we understand what might happen when stocks go up or when stocks go down, we can act before that. So when we know that stocks are going to rise, we want to watch certain types of stocks. We want to always invest, though, in a company that we know about. So really, it doesn't matter what the stocks are doing. Because the stocks, yeah, they're going to impact certain things in certain ways, but that's nothing that can be guaranteed. You cannot rely upon past performance to predict future success. So I want you all to understand that although we can talk about what's going to happen to this sector or this industry when the stock market is impacted by the interest rate, which doesn't normally happen for about 6 to 12 months after the change is made, we could spend all day talking about ifs and this and that and the other. But ultimately, the wisest choice for any investor is to make sure that you know the companies you're investing in, because then you're going to know how much debt they carry, and you're going to know whether an increase in interest is going to cost them more expense. So simply, we've talked about the vocabulary, and we understand what interest rates are, we understand what inflation is, and we understand how that impacts stock prices now. But that really doesn't matter to us, because we're going to look for the company that is going to be successful, because their success is what increases our value. We're not like the stockbrokers out there gambling on these companies winning or losing. We are loaning our money to this company so that they can use that money to grow and repay us interest on our loan, essentially through dividends. I hope that I've been able to make this complex topic simpler for you today. Thank you so much for your time.
Whatever about